Arbitrage strategy in algo trading involves taking advantage of price discrepancies of the same asset in different markets to make a profit. Arbitrage strategy in algo trading involves taking advantage of price differences for the same asset in different markets. This could be done by buying the asset in the market where it is priced lower and selling it in the market where it is priced higher, thus making a profit from the price discrepancy. Case Study 1 explores the successful implementation of an arbitrage strategy in Forex trading, showcasing the potential for lucrative gains by exploiting price differences in different markets. This effective approach to Forex trading involves leveraging the variations in exchange rates to generate profits with minimal risk. The Forex arbitrage case study utilized a specific approach involving the simultaneous purchase and sale of currency pairs to exploit pricing inefficiencies in the market. This involved scanning multiple brokers and exchanges for discrepancies in exchange rates, allowing for profit to be made from the differences in price. The tools used in this case study included advanced trading software, data feeds from multiple sources, and high-speed internet connections to ensure quick execution of trades across different platforms. The case study explores the successful implementation of an arbitrage strategy in cryptocurrency trading, showcasing the potential for profit in this dynamic market. The success of arbitrage in cryptocurrency markets is driven by factors such as high volatility, price discrepancies between exchanges, and the speed of trading algorithms. In a real-world example of an arbitrage strategy in stock market trading, a trader may take advantage of price discrepancies between the same asset in different markets. This could involve buying a stock at a lower price in one market and selling it at a higher price in another, thereby capitalizing on the difference in prices to make a profit. Algorithmic trading has revolutionized the implementation of successful arbitrage strategies by enabling rapid and automated execution of trades based on predefined algorithms. This has led to enhanced efficiency and accuracy in identifying and exploiting arbitrage opportunities across financial markets.